As housing affordability challenges persist, new legislation could create meaningful opportunities for the construction industry. Construction contributes more than 4% of US gross domestic product, while both construction employment and the number of private construction establishments have continued to trend upward. At the same time, housing affordability has become one of the country's most pressing economic challenges. Median home prices have reached an all-time high, making home ownership increasingly difficult for many Americans. Residential construction spending has remained relatively flat despite rising construction costs, while housing starts and building permits have weakened, highlighting continued constraints on housing supply. And these market conditions provide the backdrop for the recently enacted 21st Century Road to Housing Act, legislation designed to encourage additional housing supply through several targeted initiatives. Among its key provisions, the legislation places limits on large institutional investors purchasing certain single-family homes, streamlines building codes for qualifying multifamily projects, expands grant opportunities for communities that increase housing supply, and simplifies housing voucher requirements to reduce administrative barriers. Over time, these measures are expected to stimulate additional residential development, creating new opportunities for construction companies across the country. But before those impacts become visible, Experian analyzed today's construction industry using commercial credit data to better understand where the sector currently stands. One of the first observations is that the number of credit-active construction businesses has grown only modestly since 2022. Residential construction businesses increased by approximately 2%, while other construction businesses grew by about 3%. By comparison, non-construction industries experienced roughly 20% growth during the same period. Despite relatively modest business growth, credit demand has increased significantly. Commercial credit inquiries have risen sharply across both residential and non-residential construction, indicating that construction companies are actively seeking additional financing. Interestingly, this increase in credit demand has not translated into more new credit accounts. Instead, new trade line formation per active business has declined across construction and non-construction industries alike. Commercial cards continue to represent construction's primary source of new credit and generally carry higher average credit limits than those observed outside the industry. Construction companies tend to rely on more commercial lines and loans than businesses in other industries. Existing borrowers are also carrying larger balances than they were just a few years ago. Average outstanding commercial balances have steadily increased since 2023, reflecting greater use of available financing as companies manage ongoing projects and rising operating costs. But the most encouraging finding is that despite higher balances and increased revolving credit utilization, payment performance has remained relatively stable. In other words, construction companies appear to be taking on additional credit obligations without widespread signs of financial deterioration. Overall, the data suggests that construction's credit exposure has increased primarily within an established borrower base rather than through rapid expansion in the number of credit-active businesses. While residential and non-residential construction continues to follow somewhat different performance paths, the broader industry appears well positioned to respond if housing activity accelerates under the new legislation.